Hi, this is Connie Saunders with the Foreclosure Freedom Network show. This is the second in a series of shows, this one being titled Homeowner Affordability and Stability Plan, which just came out on March 4th of 2009. The President's Homeowner Affordability and Stability Plan was released then along with the lender guidelines. Let's take a look at what this means for the average Joe. I'm going to go quickly, so please forgive me on this. I just have 10 minutes. 1. Loans have to be originated before January 1st, 2009. 2. First lien loans only, not second loans or HELOCs. Then also, the properties do need to be owner occupied. And 3. The balance has to be up to $729,750. Less than that is fine. The only time you can go more than that is if you have 2 to 4 properties on and are the owner of a property that's slightly higher than that. And then number 4, all borrowers have to fully document income, including most recent pay stubs, tax returns, and signed affidavit of financial hardship. 5. Property owner must occupy the property, and this has to be verified through a credit report or other documentation, so have it ready. 6. Incentives are now offered, and this is very good news, for servicers to modify at-risk borrowers, such as negative amortization borrowers, even if they're not actually in foreclosure or delinquent yet. So anytime through December 31st of 2012, they can modify this one time. So you can't get more than one modification per this plan. And 7, it does have to pass a net present value test, and this is very done in great detail and required now. So they have to make sure that the cash flow on a loan modification for the investor is better than the cash flow on just allowing this to default and continuing this default process or foreclose. What's the better cash flow incentive for the investor? If that test is positive, meaning that the loan modification is a greater scenario, the servicer does have to modify it unless fraud is involved on the homeowner's part, or if the servicer's contract prohibits this. And I'll go into that later, servicer contract, in another show. The parameters of the net present value test include various things done like doing a property evaluation with a current market analysis, looking at the overall trend of housing in the neighborhood, and generally the condition of the property. And 8, last year 54% of all loan modifications failed because they were not sustainable. And now, with this new stability plan, it is mandatory for the lender to evaluate the sustainability of the loan modification on behalf of Fannie Mae or Freddie Mac. So they can't just offer you an unsustainable modification. So be sure to alert them if they're not proposing something sustainable. From this, you can see that sooner is better now. Get your loan modification in as soon as possible because they are getting pretty flooded. They do have to follow a very definite series of steps to reduce your payments down to what will be sustainable at what they call a front-end debt-to-income ratio. And that's calculated by taking the sum of your mortgage payment, that includes interest and principal, and property taxes and homeowner insurance, including condominium or homeowners association fees, and divided this total by the total gross monthly income. And then the homeowner, you, have to end up with no less or more than 31% of the loan amount. So it actually becomes reasonably affordable. So the first thing they do is they lower the loan to 2%. And if that doesn't get you to that 31% target, then they have to extend the term of the loan from the 30-year term up to 40-year term. But it also works in reverse. If you're on a negative amortization and interest only and have no term, then they have to roll the clock backward and put it at the 40-year mark for you. 12, then they forbear principal as needed to have the principal either forgiven or paid on a gradient, or in a tail end balloon note, or even the Hope for Homeowners program will be acceptable, and hopefully the lenders finally agree with this. Now, the monthly payment includes principal, interest, taxes, and insurance, again, and that includes flood and homeowners insurance, HOA or homeowners association fees, and the monthly income includes wages, salary, overtimes, fees, commissions, tips, social security, pensions, and all other forms of income. So don't forget some of those. Servicers must enter into the program agreement, by the way, with the Treasury assistant. So put the pressure on your servicers to enter into that agreement. 13, the program will share the cost of reducing the monthly payments from the 38% of your debt-to-income ratio down to 31% of that. So the lender will get some assistance from the government to make that go down to a more affordable level for you. He won't get assistance for any amount above that 38%, but, 14. The servicers that modify their loans according to these guidelines receive an upfront fee of $1,000 plus they get a paid for success fee at the tail end every year that is performing successfully of $1,000 per year up to 3 years. Also, if the homeowner makes their payment on time, they're eligible for up to $1,000 a year in principal reduction on your first loan as an incentive for the first 5 years. So that's a terrific advantage. And 15, the program will provide a one-time bonus incentive to the investor lender of $1,500 and $500 to the servicer for any modification made while the borrower is still current on the mortgage payment. So this is a tremendous reason for the lenders to actually originate a modification with people who otherwise would be not qualified. And finally, there is going to be Fannie Mae compliance guidelines, and any kind of fraud on your initial mortgage or on the applications and procedures for this plan will disqualify you. So please keep your noses clean. And there are going to be some later products that we'll discuss later on other shows. But for now, this is it for the Foreclosure Freedom Network show. See you next time.